Three major topics hit the headlines between last Thursday and today that is pulling everyone's attention away from the numbers that actually matter. The nomination of a new Federal Reserve chair, a stock market reacting to the new global tariffs, and a report showing that the U.S. economy is officially slowing down. Some help buyers, some pressured sellers, and one directly impacts our move-up homeowners. Let's break down exactly what changed between last Thursday and today, February 26th, and what it means for your wallet. I'm Cathy Sabater, and this is your Thursday Market Watch. Number one, GDP, the shutdown, and inflation. This week, the market reacted to the brand new Gross Domestic Product Report, also known as GDP, and the latest PCE inflation report. What mattered? Did the economy grow faster or slower than expected? Did inflation heat up or cool down? The headline data showed that economic growth slowed down dramatically to 1.4%. This is much lower than the 3% growth economists were expecting. The administration was quick to point out that this lower GDP number is somewhat artificial. They are directly blaming the 43-day government shutdown for shaving nearly 2% off of the GDP. The shutdown temporarily halted federal services and spending. It made the economy look weaker on paper than it actually is. However, the core personal consumption expenditure inflation report, which is the favorite for the feds, shows that it was cooling down and unemployment ticked up. So for your mortgage, this is actually the perfect recipe. Number two, the Federal Reserve drama this week. The financial world has been focused on the Federal Reserve, Kevin Warsh, to take over as the next Fed chair in May. Here's the key takeaway for your mortgage. What does Kevin Warsh actually believe about interest rates? He believes that new deregulation and artificial intelligence are creating a massive surge in productivity. When productivity goes up, inflation goes down, which gives the Feds plenty of room to cut interest rates. Remember, mortgage rates move on expectations, not actually Fed minutes. The market believes that the Fed will continue to cut rates under this new leadership. Investors are pricing in lower mortgage rates right now. Number three, stock volatility and tariffs. This week, we also saw a massive stock market volatility driven by discussions around the new global tariffs. When investors feel confident, money flows into the stock and bond demand weakens, and that means mortgage rates drift higher. When investors feel nervous about tariffs or global trade wars, they pull their money out of the stock market and hide it in the safe haven of U.S. bond. That's exactly what happened this week. The panic in the stock market caused a massive bond rally. That demand pushed the 10-year Treasury yield down. As a direct result, your mortgage rates improve. Where are rates today compared to last Thursday? Mortgage rates are trending down. The market is currently reacting to the perfect storm. The cooling economic data from the shutdown, expectations for Fed rate cuts, and falling Treasury yields. Today, the 30-year fixed average has dropped below 6%. It's sitting around 5.87% for most borrowers. Movement this week has been highly favorable for buyers, pushing rates to lower levels since 2022. What this means for buyers. Buyers shopping in San Diego, California, Texas, or anywhere else watching this rate movement massively affects your purchase power. Let's look at a buyer shopping around $700,000 price point today versus a week ago or 2 years ago. Rates have dropped to the high fives. You are seeing roughly $75 drop in your estimated mortgage payment. $75 may not sound or feel like it's dramatic on the surface, but over a 30-year loan, that's a $27,000 savings in interest. What does this mean for sellers? Rates are trending down and crossing that psychological 6% barrier. Buyer demand is improving. You should see more open house traffic this weekend, and multiple offer conversations are returning to the table. If your home is priced correctly and shows well, this drop in rate is exactly the catalyst you need to get your house sold quickly. What does this mean for the buy to sell or move up buyer? This is the most strategic category right now. If you're selling your current home and buying a new one simultaneously, the rate direction lowers the payments on your next home. The improved buyer demand gives you more leverage when selling your current home. In a market where rates dip into the fives, sell to buy becomes easier. This is where structuring your timeline and your loan wins the day. Is the market balancing? Well, right now, inventory is leveling out. Days on the market are consistent, and seller concessions are still on the table. But they could quickly disappear if buyer demand spikes this spring. Let me be clear. This is not a housing crash. This is simply a return to normal. A balanced market creates massive opportunity, especially in buyers who act the moment a monthly payment fits the budget. My advice for the weekend, if you're a buyer, do not wait for rates to magically drop to 3%. A sub 6% is a new sweet spot. If you find a home you love this weekend and the payment fits your budget, write the offer and lock the rate. If you want me to run the exact math on a house you are looking at this weekend, or if you need a strategy to sell and buy at the same time, comment the word strategy below and I will send you my calendar link. I'm Cathy Sabater. Have a great weekend. Let's go win your home.